All right, so your next three guests all agree that the Federal Reserve will not cut rates today. But that does not mean there is no story, because what's going to happen, as we just talked about, still a little cloudy. Let's bring in Wells Fargo's Paul Christopher, Societe Generale's Subadra Rajappa, and Northern Trust's Carl Tannenbaum. Great panel. Subadra, I will begin with you. You're, I would imagine, in the 100%, does not expect a rate cut today. What do you see happening later this year and next year?
I'm a big fan of the Lord of the Rings, so I'm going to say 2 more cuts for this year, September and December. We don't expect a change in the median dot for 2025. We could see perhaps a change, maybe inflation a tad higher, unemployment rate a tad higher, and growth a tad lower for this year, but really very much in line with what the market's pricing in for 2 cuts for this year, and perhaps 100 basis points of cuts for the next year.
But I guess, Paul Christopher, again, kind of like Steve and we talked about, alluded to, whatever, we don't know where energy prices are going to go, because we don't know how this whole thing in the Middle East is going to play out. I mean, it's possible oil could go to $100 a barrel or fall to $40 a barrel if there is, let's hope for it, some peace. How do you make any kind of estimation, guesstimation, strategic thought when it is so cloudy around a key input?
Yeah, well, if it's cloudy out there, you try to stay close to your umbrella and try to stay close to your landmarks. And for us, the main landmark here is that tariffs are coming. We're already starting to see some of that pricing come into goods. We expect it'll spike somewhere in that August, September time frame. And then tariffs being taxes, you don't get continual price increases, right? Price goes up once, tax goes up once. So then the inflation comes down, but not until it starts to slow the economy. So that really narrows the Fed's window here, probably to 1 rate cut. Now, what's the other piece that we have to carry with us? Well, we don't know what's going to happen with this conflict in the Middle East, but historically at least, those conflicts have had short-lived impacts on oil prices. And number one, and I'm not saying that they necessarily will this time, but number two, there's a lot else in the CPI that's starting to soften. And we're starting to see that in housing prices, rental prices, healthcare prices. So there's other things that could help moderate inflation and give the Fed a chance to cut here, probably one time before the end of the year.
Yeah, well said. In part because also the United States, we are not purely insulated from what happens, but at 13.5 million barrels a day, some of that gets exported. We have a little more energy independence, not full, but a little more than maybe some others. Carl, do you agree with Subadra? Do you see a couple rate cuts, but later this year?
Well, first, Brett, I would say I've been called names much worse than the president is leveling at Fed Chair Jay Powell, so hopefully he can look through that. The inflation picture can be decomposed this way. If you take a look at the core components, and energy is important, but the Fed looks at core. We have had a little bit of relief in housing prices, the biggest element, but we still have a housing shortage in the United States, so unlikely that inflation in that sector is going to come down too far. The change of tone on immigration may down the road put a little bit of upward pressure in those core service prices that the chairman has spoken about on past occasions. And then we've had great fortune with goods price deflation in many cases that has helped offset some of the other service components in the CPI. But it's very likely that towards the end of the summer, if not before, we're going to start seeing the impact of tariffs on consumer prices. And so I wouldn't be surprised if year-over-year inflation, core inflation, the Fed looks at, is going to be 3% or greater. And so even if that's only a risk, and I would agree with Steve Leisman, let's look in the back of the Fed's charts to see the risks to the outlook. Even if that's a risk, it doesn't appear that the risks to the job market are going to be nearly as large. So if we add all of that up, our feeling is that we'll get only 1 cut this year. We have it in September, but if I'm wrong, I wouldn't be surprised if it were later still in 2025.